So even if we get a drama of an event, that's a little spill that can happen. So it's possible. But for this pattern to win out, you can't run that stop. So I don't think the move's that big. You have a pullback, and then we go and we finish the 41 run, which will be a great close. And then it sets us up for, okay, can we go test 50? Probably get rejected because we've been rejected before, but that'll be the third time, the fourth time a lady, we break. And once we through 50, that fourth time pass, which I still think we've got to go visit for a third time first, that is just open territory. That's when I think actually triple digits comes rather quickly.
Francis Hunt, better known as the market sniper, lays out a bullish case for silver that stretches well beyond the noise of daily price swings. He argues that the long-term drivers, soaring debt levels, relentless currency debasement, and persistent investment demand are firmly in place. Over the coming years, silver is expected not only to climb but also to outperform gold itself eventually. That said, Hunt doesn't ignore the short-term hurdles. On the quarterly chart, silver has been pressing against historically essential levels. If it had managed to close right at those highs, it would have been the strongest quarter since the 1980s. Instead, it slipped back, a sign that the market is doing everything it can to delay a decisive breakout. For Hunt, this isn't failure but part of the process. He sees it as silver building a smaller handle within the larger cup and handle pattern, classic technical behavior before a sustained move higher. His first primary target is $41. Hunt stresses that a solid quarterly close there would be a significant milestone, setting up a run toward the psychological $50 mark. The first attempt to crack $50 will likely fall short, just as it did in both 1980 and 2011. But he believes the fourth attempt will be different. Fourth time lucky, as he puts it, could finally unleash silver into uncharted territory. Once that lid is blown off, Hunt thinks silver could accelerate into triple digits far faster than most expect. For investors, the message is clear. Short-term volatility may shake weak hands, but the structural setup for silver remains one of the most powerful in the commodity space. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
So let's start dealing with silver more directly now. The macro picture is incredibly bullish. So with everything I've said about demand, possible destroying events, the trickiness of September and October's and all of that narratives, long run, both these guys going up. In investment, high probability, debasement, debt collapse, everything. That's where I stand. Short, that was mainly a short and medium, next week and a couple of months to the year end if we had a drama. So most people are not on the worried about what it does to December. They're worried about where it'll be 2 years from now, 3 years, 5 years from now. You're all golden on those ones, on both of these, and silver will eventually be an outperformer. However, we have to also technically notice we met a couple of targets on silver. So again, for people, there'll be some people watching this and saying, do I buy today? And God forbid, be careful out there. Some people that say, should I take a leveraged long position today and hope to make money by next week? I'm not positively disposed to those people that are on the short term that may be using leverage, or people that want to buy a sizable lump sum today. I think you might get an opportunity to get it a little bit cheaper, both silver and gold. But the macro of this particular structure is absolutely bullish. Traditional technical analysts will give you the usual cup and handle narrative like that. And again, just as I highlight on the short term, these are shooting stars. That means you've been pushed back down twice. And in this current month, you're having a smaller shooting star inside the previous one. So I'm not sure if those candles are that well visible. Let me get rid of my overlay draw. But that points to not chronic ones, but it points to short term. You might get a couple of extra ounces, a little cheaper, lower down at some point. So it's not a whale in massive, put your whole life savings today in, and it's not a leverage trade long right now. But it is on a bigger time frame. I will highlight something else. And I think this is part of what they'll push back against. If we go for a quarter, so this is a 3-month chart, and I'm pulling it through again. I want to just highlight currently where you were at yesterday, and I think it's just changed today. Where you were at yesterday, if we had closed the quarter which only happens, September, end of September. So you need the rest of August and all of them. You were higher at any candle body level than any time before. So we have now already given that up. You can see that dotted line is a tiny bit below that close there. Yesterday, if we were having that discussion, you were higher than that, and that. And you can see the second half ease back that is taking place as well. So I think the quarter, they really don't want you to have a high, all-time high quarterly close. Remember, these $50 amounts, they were wicks in a quarterly that you never held for 3 months. You came right the way back down. So it's quite important to remember that. The close for that candle over there in the 1980s, many of the people watching that wouldn't have been born, and I wore a lot younger man's clothes back then. I was still in school. The open there is 37.75. We were actually 38. And the highest candle here, which is the open on that one, is open is 37.65, and the close on that one was 37.65. So we've actually been sitting at the three classic highs, the current, the 2011 and the 1980. We've actually been at a quarterly high point if we closed, and I think we fall below that. So I think we right now, short term, no. You're going to get a little bit cheaper. Sometimes with big macro, this is such a big time frame. It's a quarterly time frame. This is taking us back to 1980 and the 70s. Sometimes with a head cup and handle, that when the handle is as big as it is, don't forget this is running us 2011 to 25. You get another smaller fractal handle. The handle gets a baby handle, if that makes sense, and you fractalize again. So you could have that little pullback. It won't go anywhere near as deep, but it'll consume some time and come back up. So you're going to get a multiple triggering event. We talk about it. We did it with gold once, twice, 3 times. The 4th time, a lady. That's your break. So it's kind of like you get rejected 3 times, and then the 4th time, you've got your date. And we're at the 3rd time here. So I sense not quite yet trigger firing time for the silver market. Could go lower a little bit. That's not a bear call, by the way. This is a technician watching when's the best time to put his next lump sum in terms of this market. And you could just find yourself pulling back a bit. In terms of, you may also mentioned the HVF method, which is 3 impulses and a squeeze in volatility. We do still have a draw here that hasn't fully made its target, but did trigger. And that is the 3 impulses and the squeeze in volatility. So when you introduced, you missed the funneling word, which was hunt volatility funnel. You actually get squeezed into like a protein shake almost into the funneling, and then you break. And we broke, we made our first interim target on a wick. We pulled back, which is typical target response. Then we made the second interim target over here. Both done quite soon. And then you've been grinding higher. It's a little bit like a rising wedge. And we've got a lot of time to make this target. You'll see these vertical lines tell us our time stops. So you could still have a fall back down out of the rising wedge and that 2 shooting stars, a little bit of a pullback. I'm not even saying as far as 32. It doesn't have to be that far. It could be a bit further. You could pull back like that and then end up running the 41. The question is, will we ever get for this quarter a 41 close? And I'm not sure necessarily I can say that. Will that all happen in the next 6 weeks? Possible. So we could go down first because I'm cautioning on the short term. You probably could get a better price on the longer term. And it might not be that long. This could all happen in the next week or 2 with a bit of a yen carry trade like August last year, tail end of August last year, or the British debt situation. We get a little bit of, and then next thing you know, we are going back up. But you could also pull back a little harder and even revisit the funnel. I don't think so. That was a long way ago. That's extreme. But don't forget, we traded on spot, not that you could buy, $11 at COVID. It was either 11 or 14. We can check that now. Mm-hmm. Could forget about buying it at that price with premium. So let's just find 2020. What was the low there? Yeah, it was actually 11. But you could only buy, I think, for $14 something And that was a great buy as well. So even if we get a drama of an event, that's a little spill that can happen. So it's possible. But for this pattern to win out, you can't run that stop. So I don't think the move's that big. You have a pullback, and then we go and we finish the 41 run, which will be a great close. And then it sets us up for, okay, can we go test 50? Probably get rejected because we've been rejected before, but that'll be the third time, the fourth time a lady we break. And once we through 50, that fourth time pass, which I still think we've got to go visit for a third time first, that is just open territory. That's when I think actually triple digits comes rather quickly.
Francis Hunt makes it clear that the real forces behind gold's price aren't ordinary investors stacking coins from their paychecks. That activity barely registers. The proper drivers are central banks and big institutions. They're the lead steers of the market, and when they start accumulating, the herd follows. Their actions set the tone for every cycle. Hunt points out that gold's current bull run didn't appear out of thin air. It actually started decades ago. After the dot-com crash, gold began climbing from roughly $250 an ounce. The momentum built further during the 2008 financial crisis, when the Federal Reserve unleashed a series of quantitative easing measures QE1, QE2, and QE3. Each round weakened the dollar's credibility and pushed gold higher. Looking through the lens of Elliott wave theory, Hunt believes we're only now stepping into the third wave. That's critical, because in market history, the third wave is usually the most powerful. It can stretch 60% longer than the previous leg, and it tends to deliver the kind of explosive upside that takes people by surprise. The way Hunt frames it, gold's path is the inverse of the dollar's decline. As the dollar accelerates downward, gold doesn't just rise steadily, it curves upward in a parabola. That means the sharpest, fastest gains are still ahead. For Hunt, the lesson is straightforward. The bull market in gold is far from over, and the biggest, most dramatic moves haven't even begun. Let's get back to the interview.
There's a couple of big alpha males that lead the charge, basically, and end up being the reason why a stampede goes in a certain direction. And the lead steers for gold markets are the big institutions and the central banks. And in terms of how they are voting, they move the needle on the price. You and me, with our retail purchases of, a little bit of stacking here and there, when we're a little bit fat on the paycheck, et cetera, et cetera. We don't move the needle. We are long-term accumulators. Maybe retail over a long period will accumulate a lot. If they ever did something in a hurry, they could. But we're talking about central banks, and the debt turn was the back end of 2020 for us. But already before then, when we went into just post the dot-com crisis, which was quite a serious recession, just post the dot-com crisis, we had a softening in the US, and that's when gold started to move from its 253. Then we had the run up to 2011, which was QE1, 2, and 3 for the post-subprime crisis. So the gold trend actually has been going for a fair bit, but it's also been put on ice a few times. 2011 was not a full bull market at all. It was the first leg of a far larger multi-leg structure. If you're an Elliottian, you'll sort of understand an ABC, a BC, a CD, an EF, and a full five wave, for which we're really only partway through. And actually, the next wave in Elliottian, I'm not specifically an Elliottian, but the next wave up, which is the third leg, is usually the largest and the biggest. And it's often 61.8% larger than the previous one, which would mean the run-up from the 250 lows that ended up at the 2011 highs, which was around 1927, if you can recall. So you're talking about 250 to 2000. Let's just do Chinese rough mathematics. You're talking about an 8x just under on that. Let's call it 7.5 for want of a lie here or there. And you're going to probably do 61.8% times that if you're a standard technician in Elliott wave from the subsequent low. Now, the subsequent low was over 1,000 from the 1927 high. So imagine doing 7.5 or 8 times, but now adding 60% to that. You're kind of adding another, you're probably looking at 12 or 13, maybe 14 times from a 1,000 low. So that just points to the next biggest wave being pretty substantial in terms of debasement of fiat. Because remember, gold is going to move on account of debasement of fiat. Everybody thinks it's the gold price. It's XAU USD.
Right.
The thing that's moving is the debasement of the money. It flies at the same altitude. You put it under your bed, providing it's a safe place. It's still going to be the same size. It's going to still be the same weight. It won't rust. It won't disappear. It won't be chipped. It won't be devalued. It's the dollar that's going to be debased. And on that key point, the 54 years, because there's been a lot of excitement, and I don't buy into this hopium of people thinking that Besant is going to overshoot and reval gold at 20,000. I'm opening another kettle of fish here as usual. And I want to highlight that to me is deeply unlikely. And this is a bit of crypto moonboyism creeping into the gold bullion realm. What they could do is a mark to market. And I'm not even sure they want to do that. Remember, central banks and governments don't want to bring gold into the discussion more than they have to. They actually like ignoring it. Once you're a Federal Reserve chair, you can count the amount of times they say the word gold versus the amount of times they will talk about rates or any other core term, and it'll be exceedingly rare. Even the ones that were, Greenspan was gold regulated sound money before he became the Fed chair. Then he became Fed chair, never wanted to talk about it, never wanted to mention it. And Ron Paul would show up and poke him with a stick and keep mentioning gold. And he just didn't want to take the bait on any level. And the same went for Bernanke under Ron Paul's poking with a stick. Probably the best president America never had. But anyway, back to essentially your question. It's a debasement. We're seeing chronic debasement. And since $42.22, 54 years ago, to today's current price, round about the 3,300s level, give or take a few, and you're talking about 8.4% loss in value each year, compounded. And the interesting part of that is we've entered the escalator and the parabola phase where that number will change rapidly as a result of recent price moves. So as gold goes into a higher, faster move, the aggregate percentage for the 54 years will go up, but it will understate how much it's changed as a result of recent events. Hence why I speak about convexity. The debasement of a dollar is kind of like paying off a mortgage curve, slow at first, and then suddenly very steep. It's a slippery slate mountain that you're not slipping, you walk to the edge, and then eventually you fall over because it's starting to get a bit steep, and then you're trying to stop yourself and you just go right the way down into a vertical plunge. That convexity is gold's parabola. It's the exact inverse of that chart. That's your buying power of your dollar turning into the slippery slate, going eventually vertically down. And that's your parabola, slowly at first, but eventually steepening going up. So when you think about 54 years and that 8.4%, the best bit's still to come on that number and the true debasement of the fiat currencies. So the question is how far can we debase dollar and debt? And the problem is we have way too much debt, and we've really only just started the problem of debasing it. And there's a plethora of new debt being added. And by the way, as they've lost control of the long ends, or appear to be, that's my take, and it's happening in Japan as well, and the United Kingdom as well, and the Eurozone in time to follow, more and more is being pushed onto the short end. And the notion that you can run, but you can never hide, absolutely applies. And when you go the short end, you face a higher renewal cycle of rollovers at the same time as you're adding an ever exponential higher amount of new debt. So you're actually getting a conveyor belt of consistency. And I love to joke about the fashionability of a pair of pink Crocs. And I talk about sort of oil tankers just bringing these rubber shoes to you, and your house is already imploding with them. This is where you're at, where pink Crocs, you don't even want a pair for $5, never let alone $25. There's no money to be made. I'll actually pay you to take them away. I'm drowning in them. So how low does the debasement process have to go? It's got a huge degree. You've got 37 trillion, a number that's recently been crossed. By the way, I think we referred to that convexity curve and the parabola opposite the twins gold versus debt and the dollar on our last chat with Maggie, and I think I showed a diagram because I tried to help people with the visualization of that. So people that didn't see the first video should go and watch that one with Maggie. But we've got so much more debasement to do. We really do. We've got so much more debasement to do, and that means, dollars are already single cents of 54-year-old dollars, and they'll become decimal places of single cents of 54-year-old dollars.
Silver and platinum are dramatically outperforming gold in 2025, with CME futures data showing June gains of 9.5% and 28.2% respectively, compared to gold's modest 1.1%. Year-to-date, silver is up 27% and platinum 30%, driven by booming industrial demand and supply deficits. Silver benefits from surging demand for electronics, solar panels, and data centers, while platinum gains from stricter auto emission standards and Chinese jewelry buyers switching from expensive gold. Both metals trade at significant discounts to gold, with the gold-to-silver ratio hitting an 11-year high, signaling potential upside for investors seeking portfolio diversification beyond traditional gold holdings. Power is shifting in plain sight. What once revolved around stocks and bonds is now being recentered on assets that can't be inflated away. The steady migration of wealth into Bitcoin and gold isn't just about returns, it's about survival in a system weighed down by debt and diminishing trust. If policymakers are openly preparing for this transition, it signals that the financial order itself is entering a new phase. As institutions and governments reposition, will ordinary investors recognize this pivot in time, or will they be left holding yesterday's assets in tomorrow's economy? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.